taught in every MBA program. It's coded into every robo-advisor algorithm. Morgan Stanley just declared it obsolete. Their new model? 60% equities, 20% bonds, 20% gold. They didn't suggest gold as a 5% diversifier or a tactical hedge. They elevated it to the same status as U.S. Treasury bonds, the so-called safest asset on Earth. Why? Because Michael Wilson knows something the public doesn't. Bonds are no longer safe. In April 2025, during the height of Trump's tariff war, something unprecedented happened. The stock market crashed. Under normal conditions, money floods into Treasury bonds during equity sell-offs, the classic flight to safety. But in April 2025, bonds sold off simultaneously with stocks. Both assets collapsed together. Gold rallied. This broke 40 years of market correlation. It meant that bonds had lost their fundamental purpose, protection during crisis. Morgan Stanley watched this happen in real time across their institutional order flow. They saw sovereign wealth funds, central banks, and ultra-high net worth families all doing the same thing, selling treasuries and buying physical gold. The public didn't notice because financial media was focused on the stock market recovery. But Morgan Stanley's private wealth division, which manages money for billionaires and institutions that can actually move markets, saw the writing on the wall. By September, they made it official. Gold is now structurally superior to bonds as a defensive asset. Now, here's where this gets dangerous. U.S. retirement accounts, 401ks, IRAs, pension funds, hold $45.8 trillion. That's as of Q2 2025, the most recent verified data. These accounts are still operating on the old 60-40 model. Bonds still represent 40% of most portfolios. If even half of U.S. retirement assets shift to Morgan Stanley's new 60-20-20 allocation, that means reducing bond exposure from 40% to 20% and reallocating that 20% into gold. Do the math. 45.8 trillion times 20% equals $9.16 trillion in new gold demand. For context, the entire global gold market, every gold bar in every vault, every central bank reserve, every piece of jewelry ever made, is worth approximately $16 trillion at current prices. A $9.16 trillion demand shock would represent 57% of the world's total above-ground gold supply trying to get bought in a compressed time frame. And that's just U.S. retirement accounts. That doesn't include sovereign wealth funds, insurance companies, hedge funds, or foreign institutional capital that will follow Morgan Stanley's lead. Global annual gold mine production is approximately 3,000 tons, worth about $520 billion at current prices. The U.S. retirement reallocation alone would require 18 years of total global mine output, assuming zero demand from anyone else. But it gets worse. Morgan Stanley didn't make this announcement in a vacuum. Between September and December 2025, we saw Goldman Sachs raise their 2026 gold target to $4,400 per ounce. Bank of America projected $5,000. JP Morgan outlined a bull case for $6,000 by end of Trump's term. UBS, TD Securities, Wells Fargo all raised targets. This is coordinated positioning. Wall Street doesn't move in unison by accident. These banks compete for clients. They guard their research like state secrets. When they all pivot simultaneously toward the same asset, it means they're front-running a structural shift they know is coming. And here's the signal everyone missed. Morgan Stanley's 20% allocation announcement came on September 22nd, 2025. On that exact day, gold hit a new all-time high of $37.38 per ounce. The announcement wasn't predicting higher gold prices. It was explaining why gold had already rallied 40% year-to-date despite the Federal Reserve maintaining restrictive policy. Someone was already buying. Institutions were already repositioning. Morgan Stanley simply made public what private wealth managers were already executing in private markets. The supply crisis is already happening. Shanghai premiums, the extra cost Chinese buyers pay above COMEX futures prices, hit $8 to $10 per ounce in late 2025, indicating physical scarcity in the world's largest gold market. Registered COMEX silver inventories, the metal actually available for delivery, fell 60 to 70% since 2020, suggesting the paper-to-physical leverage in precious metals markets is at breaking point. When Morgan Stanley tells clients to allocate 20% to gold, they're not giving investment advice. They're issuing a survival instruction for the coming liquidity crisis in monetary metals. The clock starts Monday. Let's examine exactly why Morgan Stanley concluded that the 60-40 portfolio is dead, because this isn't opinion, it's forensic evidence. Every financial textbook for the past 40 years has taught the same principle. When stocks fall, bonds rise. This negative correlation is the mathematical foundation of portfolio theory. It's why institutions hold bonds at all, not for yield, but for protection. April 2025 destroyed that theory. On April 2nd, 2025, Liberation Day, President Trump announced sweeping global tariffs. The S&P 500 crashed. The NASDAQ composite plunged. Under every historical precedent, this should have triggered a massive bid for U.S. Treasury bonds as investors fled to safety. Instead, bond yields spiked. The 10-year Treasury yield jumped from 4.2% to 4.6% in a single week, meaning bond prices collapsed. When yields rise, bond values fall. Stocks were falling, bonds were falling, both simultaneously. This is what's called a correlation of one, both assets moving in the same direction. It's the nightmare scenario for portfolio managers because it means there's no hedge. Your safe assets become just as dangerous as your risky assets. Meanwhile, gold rallied from 3,100 to 3,500 in the same 3-week period. A 12.9% gain while everything else burned. This wasn't a one-off event. Throughout 2025, we saw repeated episodes of stocks and bonds selling off together. In May, an inflation print came in hot. Stocks and bonds both fell, gold up 8%. In August, the jobs report missed and recession fears spiked. Stocks and bonds sold off together, gold rallied. In October, the Fed signaled fewer rate cuts than expected. Stocks and bonds fell in tandem, gold hit 4,000. The pattern is clear. U.S. Treasury bonds have lost their safe haven status, and the reason is structural, not cyclical. U.S. federal debt now exceeds $37 trillion. The Congressional Budget Office projects deficits of $2 trillion plus annually for the next decade, even under optimistic growth assumptions. Meanwhile, foreign buyers, particularly China and Japan, have been net sellers of treasuries since 2022. So who's buying the debt? The Federal Reserve, through quantitative tightening pauses and reserve management purchases, which is just QE under a different name. In December 2025, the Fed announced $40 billion in Treasury purchases under the guise of money market operations. Financial analyst Stephanie Pomboy called it perfectly on Fox Business. They are not calling it QE, non-QE, or QE light or whatever. They are dipping their toe in the water. The balance sheet expansion is outright monetary debasement, and there's nothing better for precious metals than that. When the central bank has to buy the government's own debt because no one else will, that's not a safe haven. That's a sovereign debt trap disguised as a treasury auction. Morgan Stanley watched this unfold in real time through their institutional trading desk. They saw the order flow. They saw sovereign wealth funds quietly rotating out of U.S. debt. They saw central banks increasing gold purchases while reducing treasury holdings. That's why they changed the allocation model. Here's something that should grab your attention. For the first time since 1996, global central banks now hold more gold than U.S. Treasury bonds in their foreign exchange reserves. Let that sink in. For 28 years, the U.S. Treasury bond was the dominant reserve asset worldwide. Not anymore. According to the World Gold Council, central banks purchased over 1,000 tons of gold in 2024 and continued buying at an accelerated pace through 2025. China, Russia, India, Turkey, and Poland have been the most aggressive buyers. Why? De-dollarization. After the U.S. weaponized the dollar through sanctions against Russia in 2022 through 2024, every central bank on earth realized the same thing. Dollar reserves can be frozen. Your safe U.S. Treasury holdings can be turned into worthless paper by executive order. Gold cannot be frozen. Gold cannot be sanctioned. Gold has no counterparty risk. China's official gold reserves have increased for 15 consecutive months as of late 2025. These are only the purchases they are reporting. Analysts estimate China's actual reserves could be 2 to 3 times higher based on import data and domestic production that never leaves the country. Russia has explicitly stated its goal: reduce dollar reserves to zero, increase gold reserves to 25 to 30% of total foreign exchange holdings. Turkey's central bank has increased gold reserves from 15% to over 27% of total reserves since 2022. This isn't a trend. It's a structural regime change in how global central banks think about reserves. And here's the critical point. When central banks buy gold, they don't sell it back. It's not a trade. It's a permanent allocation. This represents a one-way flow of physical gold from Western vaults, where ETF selling occurred from 2021 to 2024, to Eastern central bank reserves, where it will sit for decades. The supply leaving the market is permanent. The monetary reset is already happening, just slowly enough that most investors don't notice until it's too late. Now, let's talk about what happened with institutional investors. From 2021 to 2024, gold-backed ETFs saw consecutive years of outflows as investors chased tech stocks and crypto. Total redemptions exceeded $30 billion. In 2025, that reversed violently. Gold ETFs recorded over $180 billion in net inflows through December 2025, according to Bloomberg data. This represents the largest annual inflow since ETF inception in 2004. This was not retail investors buying $1,000 worth of GLD in their Robinhood accounts. This was institutional capital rotating out of bonds and into monetary metals. Sprott Physical Gold Trust reported considerable success in 2025 with record inflows. BlackRock's iShares Gold Trust saw its largest weekly inflows since 2020 in November 2025. Even conservative pension funds that had zero gold exposure began allocating. Bank of America's Global Fund Managers survey showed average gold allocations at just 2.4%, with nearly 40% of managers having zero exposure. But the October 2025 survey showed that number beginning to shift upward for the first time in 3 years. Here's why this matters. If institutional allocations are currently 2.4% on average, and Morgan Stanley is recommending 20%, that implies an 8.3 times increase in institutional gold demand to meet the new allocation model. Applying that to the $45.8 trillion in U.S. retirement assets alone, current allocation at 2.4% equals $1.1 trillion. Target allocation at 20% equals $9.16 trillion. Required buying, $8 trillion in new demand. There isn't $8 trillion worth of gold available to buy. The entire global annual mine production is $520 billion. It would take 15 years of total production to satisfy U.S. retirement accounts alone. This is what Morgan Stanley knows. This is what Goldman, JP Morgan, and Bank of America know. The math doesn't work. The supply doesn't exist. That's why price targets keep getting revised higher. It's not bullish enthusiasm. It's mathematical necessity. If demand rises 8 times, but supply remains constant, price must rise proportionally. Welcome to the greatest supply squeeze in financial history. Let's do the math they don't want you to see. Current scenario, U.S. retirement assets total $45.8 trillion. Current average gold allocation sits at 2.4%. Morgan Stanley's target allocation, 20%. Required increase, 20% minus 2.4% equals 17.6% of $45.8 trillion. That's $8.06 trillion in new buying. At the current gold price of $43.40 per ounce, 8.06 trillion divided by 43.40 per ounce equals 1.86 billion ounces. Converting to metric tons, 57,800 tons. Global annual gold mine production, 3,000 tons. Timeline to meet demand, 19.3 years of total global production. And that assumes zero demand from central banks who bought over 1,000 tons in 2024 and 2025. Zero demand from other institutional investors globally. Zero demand from retail investors. Zero demand from industrial and jewelry sectors. 100% of all gold mined goes to U.S. retirement accounts. Obviously, that's impossible. So what happens instead? Price rises until demand destruction occurs, meaning gold gets expensive enough that allocations adjust downward, or new supply sources emerge, or both. But here's the trap. Morgan Stanley didn't recommend 20% gold allocation as a target for years from now. They published this as a current recommendation in September 2025. Their clients are supposed to be executing this now, which means the institutional bid is already live in the market. It's already pushing prices higher. Gold's 65% rally in 2025 wasn't speculation. It was front-running the allocation wave. Let's look at what the major banks are projecting for 2026. Morgan Stanley, 4,400 per ounce conservative estimate. Goldman Sachs, 4,400 base case, 4,800 bull case. Bank of America, 5,000. JP Morgan, 6,000 bull case by end of Trump's term in 2028. UBS, TD Securities, Wells Fargo, 4,500 to 5,000 range. The consensus seems to be 5,000 per ounce by end of 2026. But here's what they're not telling you. These targets assume orderly rotation from bonds to gold. They assume institutional flows happen gradually over 12 to 24 months. They assume no panic buying from retail investors. If retail participation begins, if the public realizes what's happening and starts buying physical gold and silver in size, these targets become laughably low. Think about the historical parallels. The 1979 to 1980 gold bull market saw gold go from 200 per ounce to 850 in 18 months. That's a 325% gain, driven by inflation fears and monetary debasement. It ended when the Fed raised rates to 20% and killed inflation. Compare that to our current setup. Gold went from 2,000 per ounce in March 2024 to 43.40 in December 2025. That's 117% in 21 months, driven by inflation, de-dollarization, fiscal crisis, and institutional allocation shift. But here's the difference. The Federal Reserve cannot raise rates to 20% because U.S. debt service would exceed $7 trillion annually. In 1980, the Fed could break inflation by crashing the economy. In 2025 and 2026, our economy is already fragile. Debt levels are 4 times higher, and raising rates would trigger sovereign default. This means gold's rally has no natural ceiling based on monetary policy. The traditional method of stopping precious metals, bull markets, aggressive rate hikes is off the table. So how high can it go? If we apply the 1979 to 1980 playbook of 325% from base, starting from $2,600 in January 2025, a 325% gain puts us at $84.50 per ounce. Is that possible? It's not only possible, it's mathematically probable if retail investors begin buying. Remember, retail participation hasn't even started yet. The Bank of America survey showed 40% of fund managers have zero gold exposure. When that shifts from 0% to even 5 to 10%, it will dwarf the current institutional bid. And here's the timeline catalyst everyone's ignoring. January 9th, 2026, Bloomberg Commodities, Index rebalancing. The Bloomberg Commodities Index is tracked by billions of dollars in passive funds that must match the new weightings. Silver currently represents 9% of the index. The new 2026 weighting drops to under 4%. That means passive funds must sell over $5 billion worth of silver futures in the 5-day roll period starting January 9th. This will create a massive short-term sell-off in silver and likely drag gold down as well due to correlation. This is intentional. Wall Street knows the allocation wave is coming. They need to shake out weak hands and create a final accumulation opportunity before prices run away from them. The index rebalancing provides the perfect cover to engineer a sell-off and buy the dip. Expect gold to retest 4,000 to 4,200 support during this shakeout. Silver could fall back towards 65 to 68. Financial media will declare the precious metals rally over. It's a lie. The dip is the buying opportunity before the largest institutional bid in monetary history hits the market. Once passive selling from index rebalancing is complete by mid-January, the allocation flows resume and prices explode higher. Here are your key dates. January 9th through 14th, 2026. Bloomberg Commodities rebalancing, expect coordinated sell-off. January 15th through 31st. Allocation flows resume. Price recovery begins. Q1 2026. 5,000 per ounce target becomes realistic as institutional positioning completes. Q2 through Q3 2026. Retail participation begins as gold breaks 5,000. Momentum accelerates. Q4 2026. Bank of America's 5,000 target likely exceeded. Watch for these warning signs. If you see these signals, it means the crisis is accelerating. Shanghai gold premium exceeds $15 per ounce, currently 8 to 10, which indicates severe physical shortage. COMEX registered inventory falls below 20 million ounces, currently 28.4 million, signaling delivery default risk. The Fed announces emergency treasury purchases beyond the current 40 billion, confirming bond market failure. Another major bank, besides Morgan Stanley, announces 20% gold allocation, confirming industry-wide pivot. Here's the final calculation. Morgan Stanley's 20% allocation recommendation wasn't investment advice, it was a warning. They're telling their wealthiest clients, the sovereign wealth funds, the billionaires, the institutions that actually move markets, to get out of bonds and into gold before the supply runs out. 9.16 trillion in demand, 57,800 tons of gold required. 19 years of global mine supply needed. The math doesn't work. Prices must rise. The only question is whether you position yourself before Wall Street completes their accumulation or after retail investors realize what's happening and panic buy into a supply crisis. Monday's rebalancing will give you one last chance to buy the dip. After that, the allocation tsunami begins.